In 1929, the stock market crashed and America entered the Great Depression. Stocks plunged nearly 90% over 3 years. Unemployment hit about 25%. Banks failed, savings vanished, and it took roughly a quarter century for major indexes to regain their old highs. In 2008, the housing crash sparked the Great Recession. US stocks fell more than 50% in roughly 18 months. Unemployment doubled to around 10%. Banks needed massive bailouts. Retirement accounts were slashed, and markets took years to fully recover. But 2025 may be something different. An everything bubble, with stocks, bonds, and real estate, all vulnerable at the same time, leaving almost nowhere to hide. The core argument is not that crashes are new, but that the current setup rhymes with 1929 and 2008 while stacking multiple extremes together. In 1929, the market was wildly overvalued and leveraged, but most households were not directly exposed. In 2008, housing and credit were the weak links, but policymakers still had room to slash rates and expand their balance sheets. In 2025, policy rates are low by historical standards. Inflation has recently spiked, and federal debt is at or above 120% of GDP, sharply limiting the ability to cut, print, or borrow without new side effects. Stocks, the S&P 500 trades at a price-to-earnings ratio in the high 20 segundos, far above long-term norms in the mid-teens, and in a zone previously associated with major peaks like 1929 and 2000. The danger is amplified by concentration. A handful of megacaps now makes up an unusually large share of total index value. So a sharp fall in these names would drag down broad benchmarks far more violently than in past cycles. AI leaders with very high multiples illustrate the speculative sentiment. Investors are paying many years of current earnings up front on the assumption of flawless growth, echoing the optimism around internet stocks in the late 1990s real estate. Residential prices in many markets sit well above long-run relationships to incomes and rents, and affordability is worse than during much of the 2000s boom, especially with higher mortgage rates. Commercial property is under even more direct pressure. U.S. office vacancy is near or above record highs, around 19 to 21%, and in some big cities such as San Francisco, rates are materially higher than pre-2020 levels. Many office buildings were financed at ultra-low rates and will need refinancing at much higher yields between 2025 and 2027. A math problem that points to more defaults, price cuts, and stress for regional lenders. Bonds and debt. Federal debt now exceeds about $36 to $37 trillion, around 120% plus of GDP, and is rising quickly. Interest costs are one of the fastest growing parts of the federal budget, and projections show debt to GDP remaining very high, or climbing further if current trends continue. When debt loads are this large, each percentage point move in yields adds hundreds of billions in interest, forcing choices among deep spending cuts, higher taxes, or more aggressive money creation, all of which carry recession or inflation risks. Fragile system, limited tools. On top of valuations and debt, there are structural stress points. An inverted yield curve in 2022, record consumer borrowing at high rates, and rising delinquencies in categories like credit cards and autos. Commercial real estate weakness, regional bank exposure to property loans, and concentrated equity leadership all increase the odds that a relatively small trigger an earnings miss, a bank failure, or a geopolitical shock could start a cascade. At the same time, policymakers have less credibility and less perceived dry powder than in 2008, making it harder to deploy the same playbook without risking another inflation spike or loss of confidence in government debt. Why the 2025 window feels dangerous. Yield curve history suggests that recessions typically arrive months after the curve inverts, placing 2025 to 26 in a high-risk window rather than a precise countdown to collapse. High equity valuations, stretched real estate, record public debt, and strained consumers together mean that any downturn could be deeper and more prolonged than the post-2008 cycle, especially if asset prices, jobs, and credit all weaken at once. The mathematics of high leverage and limited policy space do not guarantee a specific crash path, but they do mean that ignoring these red flags is itself a major risk.